My name is Amandeep Singh and I am a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I will discuss key things you need to know as a Canadian before making passive investments in the US real estate. Owning real estate in the US is an attractive option for many Canadians. You might own a vacation property to escape the winter months, or might have purchased a home or a condo for your child who might be studying in the US. Whether you are earning rental income, buying or selling a US property, you need to be aware of planning and compliance issues related to such investment. Let's talk about passive income, that is, rental income from your US property. For US tax purposes, for any gross rental income which you earn from your property, a 30% US withholding tax applies. Your property's tenant is required to withhold the tax and remit it to the US tax authority on your behalf. To avoid the 30% gross revenue tax on your US property, you may elect to treat the passive rental income as income that is effectively connected with the conduct of a US trade or business. By making this selection, you can reduce your rental income by deducting various expenses associated with the rental activity, such as property taxes, insurance, etc. If you elect to pay taxes on a net profit basis, you must file a US tax return to determine the amount of US tax owed. If you elect this option, you will need to apply for a US tax identification number. Always report your US rental income. Please keep in mind that you must report all US rental income earned to the CRA. You can receive foreign tax credits from CRA for the federal and state income tax that you pay in the United States. These foreign tax credits may offset the tax which you owe in Canada. If you can get enough foreign tax credits, you may be able to avoid full double taxation. You see that if you fail to report your rental income in both Canada and the US, you might have to face penalties and massive added interest charges to any income tax that you should have paid previously. You may also face other tax consequences, such as missing out on the opportunity to carry forward losses in future tax years. Always report the sale of your US real estate. For Canadian tax purposes, you must report the sale of your US property on your Canadian tax return, taking into account any foreign currency changes on the calculation of the capital gains or loss. This is very important because CRA pays very close attention to ensure any capital gain is reported on the Canadian tax return. The gain is 50% taxable based on your marginal tax rate. You may claim a foreign tax credit for any US tax paid on the capital gain to reduce your Canadian liability, as this can help you avoid double taxation of your income. Please keep in mind that if you purchase a vacation property in the US, then you may designate it as your principal residence for the years in which you resided there at some time during the year. While you can claim the principal residence exemption to decrease or even wipe out your Canadian capital gains tax if you own more than one residence whose price has appreciated, you might be better off saving it for when you sell your Canadian home. Well, why? Well, because if you do not make this election, you will not get a foreign tax credit for any taxes paid in the US, which are non-refundable. For example, if you bought your California condo for, let's say, $500,000 in 2012 when the US dollar was almost equal to the Canadian dollar, but you sold this in 2020, the same amount when the foreign exchange rate is 1.32, you could have no gain for US tax purposes but $160,000 gain to report in Canada with no offsetting foreign tax credit. You see, always report your foreign property. If you own foreign property with a cost of more than $100,000 at any point in the year, you must file CRA Form T1135. While foreign property for this purpose does not include your personal use property, for example, you don't have to report your California condo if it's not rented out and is being solely used as a vacation home. But if you own foreign rental or commercial property, you must report the details of your property on the form. Please be aware that the failure to file the T1135 can result in strict penalties from the CRA, even if you report all of your foreign property income. Please be sure you speak to a chartered professional accountant to help you understand passive investment in US real estate. If you want to be notified about my new tax updates on tax planning tips and tricks, please consider subscribing to my YouTube channel. Thanks for watching and see you in my next video. Until then, bye.